Hello, I'm Dr. Todd Jackson. Today we will be covering the gross profit inventory estimation method. This is a method that's used to obtain approximate year-end inventory values in various situations, such as when a company desires to prepare interim financial statements without taking a physical inventory. This method can be used in budgeting and planning purposes to project inventory values as of a particular date and the corresponding cost of goods sold values. And it can also be used to establish the amount of inventory that was lost due to some catastrophe such as a fire or perhaps by theft. The method itself is not acceptable for determining the reportable amount of inventory on published annual financial statements. However, external auditors may well find this a useful tool for assessing the reasonableness of the inventory disclosure that management has made in those financial statements. The name itself implies that the method is based upon the gross profit measure that's found in the income statement. Recall that gross profit is determined by taking the net sales for a period, subtracting the cost of goods sold. And for many companies, we'll find that this relationship between gross profit and net sales is fairly stable over time, and it is the stability of that relationship upon which we may rely for the purpose of estimating inventory. And so particularly we're going to be talking about the gross profit percentage, and when we talk about that, that can be specified in different ways. Oftentimes we refer to it as a percentage based upon net sales, and it can also be expressed as a percentage based upon cost of goods sold. And you might find either manner of expressing the gross profit percentage in a CPA exam question. So even though it's called the gross profit method and we have a gross profit percentage that's provided to us, we'll find that really it is the complement of the gross profit percentage based on net sales that we are really interested in terms of being able to estimate the cost of goods sold for the period and hence determine the ending inventory. And so we say the complement of the gross profit method is really the cost of goods sold percentage based upon net sales. And so once again, in this gross profit method, we are going to use the percentage that cost of goods sold is of net sales, along with a few other inputs such as the beginning inventory for the period, the net sales for the period, and the net purchases for the period. So as I've already indicated, in a particular, say, CPA problem, the gross profit percentage might be specified relative to net sales. That is, gross profit is expressed as a fraction or percentage of net sales, or it could be expressed as a percentage or a fraction of cost of goods sold, wherein gross profit divided by cost of goods sold gives us the percentage that's provided to us in the problem. So the easy situation is where the gross profit is provided to us relative to net sales. Because if that's the case, we get our cost of goods sold percentage, which I'm indicating here by the abbreviation COGS %, as the complement of the gross profit percentage relative to net sales. So we merely subtract the percentage provided from 1. We'll see that we'll then be able to multiply that by our net sales for the period to get our estimated cost of goods sold for the period. However, as already noted, sometimes the gross profit percentage will be provided to us relative to cost of goods sold. That is, gross profit will be expressed as a percentage or fraction of cost of goods sold. If that's the case, then we need to convert it to a gross profit percentage that is relative to net sales and then subtract that from 1 to get our cost of goods sold percentage. It's a fairly easy conversion. Basically, we take that gross profit percentage that we're provided relative to cost of goods sold, and we divide it by 1 plus that same percentage. So if we look back to our two views here with regard to cost of goods sold, the first being where cost of goods sold is provided relative to net sales. Suppose that our gross profit ratio relative to net sales is provided to us as 0.2 or 20%. Then we'll see that our cost of goods sold percentage is 1 minus 0.2 to give us 0.8, or of course 80%. But what if our cost of goods sold, or rather our gross profit percentage, was provided to us relative to cost of goods sold, and that amount was given to us as 25%, so 0.25 or 25%. Well, if that's the case, we would get our cost of goods sold percentage by taking 1 minus 0.25 over 1 plus 0.25, or 1.25. And we'll see that 0.25 divided by 1.25 is 0.2. So this gives us 1 minus 0.2, or 0.8, or of course 80%. So we see from these examples that either way of expressing the problem could be seen, and they are equivalent. We could be given the gross profit percentage relative to net sales at 20%, or we could be given the gross profit percentage relative to cost of goods sold at 25%, and we effectively convert that to a cost of goods sold percentage in both cases of 80%. So having obtained the correct or the desired cost of goods sold percentage, we then use that in a reformulated or a version of the cost of goods sold computation. That, as we can remember, that our cost of goods sold computation is our goods available for sale, which is our beginning inventory, plus our net purchases, subtracting what we did not sell, our ending inventory, to give us the cost of what we did sell. And we recognize, well, we can interchange those two. If we have our goods available for sale, again, our beginning inventory plus our net purchases, we subtract the cost of what we did sell, that gives us or leaves us with the cost of what we did not sell, our ending inventory. Then we recognize that we can use that cost of goods sold percentage that we have obtained from working with our gross profit percentage in whichever form it's provided, to apply against our net sales to get an estimate of our cost of goods sold. So if we know our actual beginning inventory, we know our net purchases for the period, and we can estimate our cost of goods sold for the period based upon our actual sales for the period and a percentage measure of our cost of goods sold, again, that should be relatively stable from period to period, we can get our ending inventory, or at least an estimate of our ending inventory. So let's take a look at an example. This says that Andrew Company had merchandise inventory consisting of $600,000 available as of January 1st, 2000 XO. For the year-to-date period ending August 31, 2000 XO, the date of a major warehouse fire, the following information is available. And so we have the purchases for the period, effectively January 1st through August 31st, $3.1 million. We've got the purchase returns, $200,000. We have freight in at $300,000, sales at $4.4 million. There's sales discounts of $250,000 and sales returns of $150,000. In recent years, Andrew Company has experienced a 60% gross profit percentage relative to net sales. If inventory costing $200,000 was found to have not been destroyed by the fire, what was the estimated cost of the inventory destroyed? So again, we're going to work with that modified form of the cost of goods sold computation, we will start with the beginning inventory. That again is our January 1st, 2000 XO amount, and that was $600,000. Let's add our net purchases. Now we can obtain from the amounts provided the purchases, gross purchases, $3.1 million. We need to subtract any purchase returns, $200,000, and then add the freight in as an additional cost of our purchases. And so that will of course take us to $3.2 million. That will give us our goods available for sale at $3.8 million. We can then subtract an estimate of our cost of goods sold. I'll just say COGS here, estimated cost of goods sold. And as we talked about, we can get that by taking our net sales and multiplying that by our cost of goods sold percentage. So the net sales we'll obtain by taking the sales, $4.4 million, and subtracting the two contra sales amounts that we have, the sales discounts and the sales returns. And that will give us $4 million. The cost of goods sold percentage is the complement. Now we'll notice that the percentage was specified relative to net sales, and that's the form you probably hope to receive it in, so you don't have to make a conversion. You don't have to convert it to the percentage based or relative to net sales. So you need the complement though. That's the gross profit percentage. The cost of goods sold percentage will be the complement of that. So we'll just note that that's 100% minus 60%. And so it's 40% as our factor. And that of course gives us 1.6 million as our estimated cost of goods sold. As we subtract that, that will give us our estimated inventory as of the date of the fire, which is August 31st, 2000 XO. And that will be $2.2 million. Of course, the question says, what was the estimated cost of the inventory destroyed? Well, we are told that $200,000 was not destroyed, so we'll just have to subtract the inventory that was not destroyed, or we could say the inventory salvaged, to get the, we'll say the estimated cost of inventory destroyed. As $2 million. Okay, fairly simple, relatively straightforward problem if you're familiar with cost of goods sold computation. And again, you can recognize the form in which the gross profit percentage is applied or provided to you. And if it is provided relative to net sales, then just crank right through it. We'll note here that the problem could have been worded differently. Instead of wording this as 60% of gross profit relative to sales, this could have been worded as 150% of gross profit relative to cost of goods sold. Now you can see different variations of that. It could be expressed as a 50% markup, that gross profit reflects a 50% markup on cost. That would imply that gross profit is 150% of cost of goods sold. Either way, you would again need to convert that to a cost of goods sold percentage by taking 1 minus, in this case it would be 150%, or 1.5 over 1 plus 1.5. That of course gives you 1 minus 1.5 over 2.5. That's equal to 1 minus 0.6, which of course is equal to 0.4 or 40%. Okay, so giving us our cost of goods sold percentage that we had in our initial computation. So again, the problem could have been worded that way. The calculation would have essentially been the same once we made this conversion to get our cost of goods sold percentage. Okay, so we'll move on to additional CPA topics.